Simplified DCF. This method is a basic version of the discounted cash flow, where we estimate a company's value using future cash flows, simplified for easier understanding. To start with Simplified DCF, simply click on toggle next to Simplified DCF. A new window will open. Here, you can upload your financials. Starting with inputs of income statements such as current EBIT, current interest expense, current capital spending. Then, we can move on to balance sheet and tax information. Next will be adjustments to current financial information. Here, answer the questions for operating leases, R&D leases, and operating expenses using the Yes and No select option. Based on your selected option, input your details. Start by entering the current year's operating lease expense, followed by your future lease commitments for each year. If you have payments beyond year 10, enter their total under year 11 and thereafter. Now let's move to the R&D converter. Enter how many years you'll spread R&D costs and add the current year's expense. Include past year's data for full accuracy. Choose when to capitalize. By default, it's end of year. Next, in operating expenses amortization, set the amortization period, add the current and past expenses, and pick the capitalization timing, end or beginning of year. Now, in discount rate inputs, current beta is a measure of the company's stock volatility relative to the market. In explicit forecast section, select how many years you want to forecast your financials. Accordingly, input your forecasted financials. Explicit forecast period. How many years do you wish to perform projections? Just input the number of years you want to forecast growth. Then choose if you want separate growth rate for each year of a common one for all. Here, you will define key assumptions for your forward-looking estimates. First, choose whether to use current working capital as a percentage of current revenue for future projections. Next, select how you'd like to estimate capital expenditures. By default, the CapEx growth rate equals the revenue growth rate. Then, enter the expected useful life of future CapEx, typically set at 10 years. Finally, choose the CapEx investment timing, either at the end of the year by default or at the beginning of the year if preferred. In the Stable Growth Inputs section, enter your assumptions for long-term steady growth, including revenue, cost, and reinvestment rates. In the Per Share Inputs section, enter details like shares outstanding, stock price, and equity options, data to accurately calculate valuation metrics, and WACC. Alright, now click on Calculate DCF to proceed. The executive summary provides a snapshot of your company's valuation and key financial metrics. It includes fair value of equity, enterprise value, cash, debt, and surplus assets, giving a clear view of total business worth. You'll also see a detailed WACC analysis, cost of capital breakdown, and share information summarizing pre- and post-money valuations. The comprehensive forecast presents a complete multi-year financial projection, showing revenue growth, margins, taxes, reinvestments, discounting, and final equity valuation. The Schedules section provides detailed breakdowns of key adjustments, including R&D capitalization, other expenses, operating leases, EBIT adjustments, and NOL utilization to support accurate valuation analysis. Now select the methods you want and enter your financials. Our tool will generate a detailed valuation report instantly. Choose your methods and let's start on this journey together.